disturbance for the class. Okay, friends, because it is a quick review, we will be touching all those topics which are most essential for your examination. And wherever required, some questions will be also asked, and you can try to answer those questions. Okay, let us start with the lesson. So the principles of bookkeeping and accountancy is the starting topic in the B&C module. What is bookkeeping? Bookkeeping means recording of business transactions in the books of the original entry and in ledgers. So whenever some transactions are taking place in a business organization, it is immediately recorded in the original book of entry, which is known as journal. So for examination, sometimes they will ask, which is the original book of entry in the case of a business unit? It is nothing but journal, because the journal you are recording then and there. Immediately after a transaction is taking place, you will record that transaction in the journal in a chronological order. You will not wait for the evening or the night time to record this book. You cannot summarize like that. You have to record it then and there. That is why it is known as book of original entry. Later, after the due classification in the journal, it will be posted to, each and every account will be posted to a separate book known as ledger. And because of that posting, you can summarize your transaction. So there are three aspects in bookkeeping. One is recording of transaction. Second one is classifying of transaction. And the third one is summarizing of transaction. And when you talk about bookkeeping and accountancy is a wider term because it includes bookkeeping also. So accountancy is nothing but a compilation of accounts in such a way that one is in a position to know the state of affairs of the business. What is the state of affairs of the business? It is nothing but listing the assets and liabilities of the particular business unit. Find out the profit of the particular unit. So accounting is nothing but the language of a business. This is the language for communicating business results and performance of an enterprise through financial statements. When you talk about financial statements, it includes balance sheet, which shows the position of assets and liabilities, and profit and loss account, which shows the position of profit or loss, statement of changes in the financial position, which is known as fund flow and cash flow analysis, and of course notes to account. Wherever some explanation is needed, it will be given under notes to accounts, and wherever it is essential, other schedules are also added to it. So when you talk about financial statement, the first thing which has to come to your mind is balance sheet. And balance sheet means position of assets and liabilities. Profit and loss account means position of profit or loss. And of course, the fund flow and cash flow statements also denote certain financial position. There are certain features for this accounting. It is an art of recording, classifying, and summarizing what I have already told. All transactions and events of financial character, most important. In accountancy, those transactions which can be expressed in terms of money, that is financial character, only can be recorded. That is why there is a concept known as money measurement concept, which is being discussed in accountancy. So this bookkeeping is an art of recording transactions in a significant manner in terms of money, and which facilitates interpretation of the results and ascertain the results of the operation, that is profit or loss. So accounting is an art of recording, classifying, summarizing business transaction. Okay. What is the end result of this accounting? The end result is we will study in this order how to post a particular business entry in journal. Sorry, how to record a business transaction in a journal, how to post it in a ledger thereafter. After that, we have to balance the ledger. Then we have to prepare trial balance. With the help of trial balance, we can prepare profit and loss account and the balance sheet. So this is the order. First one is journal. Second one is ledger. Thereafter trial balance. Thereafter profit and loss account. Thereafter balance sheet. This is the order in which the bookkeeping lesson starts. What are the purpose and objectives of accounting? To keep systematic record of business transactions, because we cannot remember.
Trial balance and trading account are same, sir.
Trial balance? Pardon?
Trading account are same.
No. Trial balance is different. Trading and profit and loss account is different. Trading account is a part of profit and loss account. Trial balance is a summary of accounts, debits and credits. So the object of accounting is to keep systematic record of business transactions and events of the business. Keep your mic in mute position, please.
Sir, will you share this PPT after this class?
This is not PPT, madam. This is the notes of IBS only. The same book I am sharing. In the book it is there. Yeah.
Okay, thank you, sir.
So keep systematic record of business transactions and events of the business is the most important objective of accounting. To ascertain the results of operations, that is profit and loss, is prepared. To ascertain the financial position, that is balance sheet. So whenever I talk about ascertaining the financial position or affairs of the business, immediately it should come to your mind that it is nothing but balance sheet. When I talk about the operations of the particular unit, operations means what? The main business. The main business is for what purpose? To earn profit, is it not? So when I talk about operations, it is nothing but it relates to profit and loss account. So affairs means affairs of the business means balance sheet. Operations means profit and loss account. To facilitate rational thinking, decision making, accounting information help management to take better financial decision in order to run the business in a better way. So satisfy the requirements of law, companies, societies, public, and trust. Compulsorily, the accounts are to be maintained. And mostly you might have heard that. In business form like or entities like or companies and LLPs and registered organizations, there are certain rules. In banks also. They have prescribed certain forms through which only the accounting can be expressed. The financial result should be expressed in such a particular form only. So the accounting, the end use of accountants, who are the end users? The shareholders, the investors, the bankers, the financial institutions, government, creditors, suppliers, financial analysts, researchers, management, employees, and even any person who is dealing with the business organization. What is a business transaction? Business transaction means the exchange of goods and services from one person to another person for a financial benefit. Suppose some benefit is exchanged between two persons with a financial benefit, that is a profit motive. Then we can say that it is a business transaction. In other words, dealing or an event such as loss of goods by fire, theft, etc., depreciation, there also we can feel certain financial impact in the business. So wherever it is quantified in the form of money, financial implication, then we can say that that particular transaction will end up with a business transaction. Broadly, the business transactions are classified into two categories. First one is cash transaction, wherever the immediate payment or receipt of cash is happening. So suppose you analyze one transaction. If there is immediate payment or receipt of cash in that particular transaction, we can say that it is a cash transaction. One example we have given here in our book, purchased goods for cash. So normally business organization will purchase goods for the purpose of resale. So this business unit has purchased goods for cash. Since the cash payment is immediately effected, we can say that it is a cash transaction. Suppose the payment of cash is deferred for a future date. For example, the firm has purchased goods from one Mr. A on credit. There, the value of the goods to Mr. A, the payment of cash is not made immediately. The payment is deferred for a future date. In the transaction, we can say that it is a credit transaction. So cash and credit transaction bifurcation is most important for your journal. Because when you read a transaction, you should understand whether it is a cash transaction or credit transaction. Of course, in ancient times, there were barter transaction, that is exchange of goods and services, not for money, but for similar goods or services. So those days, the medium of money was not there or not extensively used. But now it is not possible. Everything is expressed in terms of money. There are certain words which we will use in the business language. We have to familiarize with that. The first of its kind is capital. Suppose Mr. A has started business with cash. We will say that Mr. A has started business with the cash rupees by way of capital. Capital is nothing but the contribution made by the owner. The contribution made by the owner in the business is known as capital. Then there may be a doubt in your mind. Sir, owner himself is bringing cash. Why should we treat like that? Because it is his own money. We are preparing his own accounts. But here you have to think in a different way. There is a concept known as business entity concept in accountancy. This concept says that you have to treat the owner separately from the business. Even though the owner himself is investing cash for this business, even though he is starting the business, but he is an outsider from the point of view of this business. That is, he is a creditor. A person who is giving cash to the business is a creditor. A person to whom, a debtor and creditor relationship here. The owner is the creditor here because the firm owes this much amount to the owner. He has invested money. So he is a creditor in that sense. So business entity concept says that the owner should be treated separately when you write the accounts of the business. For the time being, you presume yourself as an accountant of this firm, not as an employee of the bank, not as an outsider. When you learn accountancy, you learn in such a way that you have been appointed as the accountant of that particular business organization. From that angle, you have to think. So if you think like that, the person, the owner who has contributed money to the business is an outsider creditor. So capital, now you tell me whether capital is a liability or asset of the business.
Liability, sir.
Liability. Yeah. Why? Because the
Liability,
business
sir.
firm is liable to that extent to the owner. So it is a liability. Now you tell me, suppose in the examination there is a question, capital is treated as a liability in the business of the particular entity. What is the concept followed by the accounting?
Business
entity concept.
Very good. Business entity concept. Because of that concept, the capital is being treated as a liability. Then comes capital is of two types. That is, whatever the person, the owner who is bringing cash, definitely it has to be invested in some assets. Is it not? In order to do the business. So when he invests his money in current assets, we can call that part of capital as working capital, short-term capital. And if he invests the money which he brought into the business in fixed assets like furniture, building, machinery, fixtures, like that, then we will say that he has invested money in fixed assets. So the capital portion is known as fixed capital. From this, we can learn that the capital which the owner is brought into the business will be invested in the business in the form of assets in two types. One is for short-term needs, current assets. Another one is for long-term needs, fixed assets. The portion of capital invested in current asset is known as working capital. The portion of capital invested in the fixed asset is known as fixed capital. Similarly, there may be times when the owner withdraw money for his personal use, or he may withdraw goods from the business for his personal use, household purposes. So when he withdraw money from the business, we will call it as drawings. So drawings is just opposite of capital. Now you tell me whether drawings is an asset or liability of the business.
Liability.
Assets.
Sir.
Because a drawing is the opposite of capital. When capital is a liability, definitely drawing is an asset. But mostly we will not show this item in the asset side of the balance sheet. Instead, it will be deducted from the capital in the liability side. If you show an item in the asset side, the effect will be same if you deduct the same in the liability side, is it not? So in that way, suppose a question comes whether drawings is an asset or capital, asset or liability of a particular enterprise, you should be sure that it is nothing but an asset, because that much amount is owing to the business. The owner has withdrawn this money, he has to bring it back. The owner has withdrawn goods, he has to pay the money for that. Is it not? In that sense, it is an asset. Then comes, of course, liabilities and assets in the balance sheet. Liabilities are those items which the firm owes, and assets are those items which the firm owns. Liabilities may be short-term liability and long-term liability. Short-term liability means those liability which has to be liquidated within a period of 12 months. Normally, we will call it as current liability. And other than current liability, all other liabilities are term liabilities. Actually, capital is also a term liability, but in order to bifurcate the liability into owner and outsider, we are using the term capital. Similarly, there may be an item known as contingent liability. There is a liability, but it is not materializing as a liability at present. It may become a liability future. For example, if there is a case pending against the firm in a court of law, the verdict of the particular case or suit may be sometimes favorable to the business or sometimes unfavorable. If unfavorable, the firm has to make the payment. If it is favorable, the firm is not supposed to make the payment. In that sense, some liabilities are there which cannot be quantified now, which will not materializing now, but may or may not become a liability on a future date. So may or may not is the key word which is to be remembered, contingent liability. So those liabilities, since it is contingent in nature, we will not show this liability inside the balance sheet. Normally, it is known as off-balance sheet item, OFF, off-balance sheet item. Note it down. Contingent liabilities are always known as off-balance sheet items. Off-balance sheet means outside the balance sheet, because the financial implication is not yet confirmed. The financial obligation is not yet confirmed. Yet to be confirmed. It may or may not fall upon us. Then comes assets, asset side of the balance sheet. Whatever the firm owns is an asset. Normally,
sir, what are the examples of contingent liabilities, sir? Use some examples of contingent liabilities.
Contingent liability, your bank guarantee.
Yes, sir.
Yes, like that one. So many items are there in contingent liability. Whatever liability which are not falling upon you for the time being, whatever commitments you have, but there is no, it may or may not fall upon you. That is, there is a contingency. Okay.
Sir, ACA
So
account.
what is the main difference of contingent liabilities and contingent assets, sir?
Contingent assets are also there. in some of the company accounts, you can see that contingent assets are other, but there we will call it as a fictitious asset. In the case of assets, it will be known as fictitious or intangible, like that.
Sir, is it include LC?
Yeah,
Aka account.
Yeah, LC, everything in bankers language, if you can easily understand whatever derivatives LC is issued by the bank. No, in the balance sheet of the bank, it is contingent liability. Because LC, there is no commitment of the bank so far. There is a commitment, but the commitment will materialize only when the party failed to honor the LC. Is it not? In that sense, it is an off-balance sheet item.
Sir, Aka account.
Auka account is also outside the balance sheet item only. If there is any contra entries are there, advance under collection, then normally the bank will treat it as a balance sheet item. But in my opinion, it is only a contra entries. It is only a contingent liability like of transactions. It may or may not recover, is it not? Okay. Assets. Assets includes fixed assets, current assets, tangible assets, intangible assets. So assets are of 4 categories. Current assets, those assets which can be converted into cash within a minimum period of 12, maximum period of 12 months, not minimum, maximum period of 12 months. Fixed assets are those assets which are not current asset, non-current asset. That means the amount invested in the fixed asset is fixed for certain period of time. Okay. Then tangible assets, intangible assets, normally all assets you can convert into tangible as well as intangible real accounts. We will come to that later. Fictitious assets somewhat relevant, somewhat it is matching with the intangibles, but there are very few differences between fictitious assets and intangibles. In intangibles, normally you have to remember these words: goodwill, patents, copyrights, etc. are intangible assets. Fictitious asset, of course, is not falling under this category, but it is, suppose some accumulated loss is there, discount on issue of shares are there, preliminary expenses are there, those type of expenditure which are made in lump sum and the benefit of which will be derived over a period of time, those can be classified under fictitious asset. So you have to just read these topics in the IBS note so that 1 or 2 questions you will get in the examination. Similarly, revenues are there. Revenue means the sales is the most important revenue for any business organization. Revenue, income is there. Other income, that is revenue. Other income means other than sales, suppose some commission you are getting or discount you are getting, then we can say that it is other than the major revenue sales, miscellaneous revenue. Then of course, capital expenditure and revenue expenditures are also there. Any expenditure, the end use of that expenditure, if it results with an acquisition of an asset, then it is a capital expenditure. Suppose you are spending 50,000 from the cash box. You are sitting in the cash box, you are the cashier of the organization, and you are giving 50,000 to a particular party and you are getting back a furniture. So this 50,000 which you are taking from the cash box is an expenditure, is it not? But this expenditure has resulted in acquisition of an asset, fixed asset known as furniture. So the end result is a new fixed asset have been created. So that expenditure we can call it as a capital expenditure. Revenue expenditure means, suppose you are giving salary to the salesman. You are giving a rent for the premises. You are remitting electricity charges. The end result, there is no creation of fixed asset, is it not? Because of that particular expenditure, whether what have happened, the end result is not a creation of fixed asset, but it has been used in the business. It has been spent. The amount is spent in the business to run the business. Because without paying salary, nobody will work for you. Without paying commission, nobody will give you service. Without giving rent, nobody will lease out the premises, is it not? So in that sense, in order to run the business, if you expend something, then it is a revenue expenditure. Similarly, loss and gains are also there. Definitely business means both the loss and gain will happen. And another major activity of a business is purchase of goods. Because the business he is doing is for sale of goods. So purchase is an everyday transaction. Often the business will do that. So the amount of goods purchased by the business organization for the purpose of resale only can be treated as purchase. Suppose the business is a provision store and they are purchasing an almirah for the particular business entity. Here, the purchase of almirah is not for the purpose of resale. Hence, that purchase cannot be treated as a normal purchase. It can be treated as only a purchase of fixed asset. Is it not? So, when you can call a transaction as a purchase, if that purchase is for the purpose of resale. If you want to sell it further, that particular item, because of that you are purchasing, then it is a purchase. Otherwise, you should not treat it as a purchase. Why I am saying like that? There are two instances which you have to identify. One is the problem will say that purchased goods worth rupees 50,000. Purchased goods worth rupees 50,000. In another scenario, purchased furniture worth rupees 50,000. Here, these two purchases have different meaning. The first one is the goods are purchased for the purpose of resale. There we have to account it in purchases account. The second case, the purchase of furniture is for running the business. So there the furniture account should be debited instead of purchase account. This is the difference. So when you purchase something for the purpose of resale, you have to debit purchases account. When you purchase something in order to run the business, not for the purpose of resale, then you have to debit that particular fixed asset account. Similarly, sales. When you sell goods, it's a regular activity of a business, then it has to be credited to sales account. We will come to that, debit credit rules and other things. Sales returns, purchase returns are on the opposite of that purchase and sales. So when purchases are happening, definitely sometimes we will return some of the goods, is it not? Maybe due to poor quality or maybe due to some other reasons, then we have to account it. Similarly, sales, when we sell goods, our customers may return the goods because of some defect or because of any other reason. It has to be recorded in sales return separately. So the goods, when you purchase it, we will call it as purchase. If purchased goods are returned, we will call it as purchase returns. If we sell the goods, it is known as sales. If the sold out goods are returned, then it is sales returns. Of course, whatever is remaining with you, the goods is known as stock. Stock may have opening stock and closing stock. Last year's closing stock will be this year's opening stock. And sometimes we will come across with the terminology of average stock also. Average stock is nothing but opening stock plus closing stock divided by 2. Then comes debtors, the person who have purchased goods from us. We will call them as customers. All debtors are customers, our customers. Our means you are running the organization, is it not? You are the accountant of the business organization. From your point of view, whoever purchased goods from your organization is a debtor for you. That is, they are customers of your organization. Debtors are the customers of the organization. They owed money to us. So the person from whom something is owed to us is known as debtor. Similarly, accounts receivable is the same way. We can put it in the same way as that of debtor. Account receivables consist of debtors as well as bills receivable, because debtors may have, the receivables may have two aspects. One is when you call it as receivables, it has two aspects. That is, one is debtors, another one is bills receivable. Why? Because mostly business transactions are taking place on certain faith. Because of the long-standing relationship, you are selling goods to a particular customer, and in turn you are not taking any negotiable instrument because you have that much trust with him. As a supporting one or collateral, you are not asking him any check or bill of exchange or promissory note. That customer will be placed under debtor because you sold the goods on credit, but you have not obtained any negotiable instrument in support of the transaction. Because you have that much faith, definitely he will pay because you have long-standing relationship with him. But in the same way, you are selling goods to some party, and in turn you are getting or you are asking him a negotiable instrument in support of a transaction, then it is known as bills received. So that is the difference between debtors and bills received. Both are receivables only, both are debtors only. The first one is without any supporting negotiable instrument. The second one is with the supporting negotiable instrument. This is the difference. If you club together, we will call it as accounts receivable. So accounts receivable is nothing but debtors and bills receivable. Similarly, creditors, the person to whom something is owed by us. We have purchased goods on certain credit terms. So they are supplier of goods. We have to pay that money back to the supplier. In that sense, they are creditors. And similarly, if suppose they are asking for a bill of exchange from us, just like we have seen in the receivables, here also sometimes our supplier may insist for our acceptance. Then we will give our acceptance, bills payable. So both put together, creditors and bills payable put together, it will be accounts payable. This is regarding the basics of the accounting. Now we will move to the classification angle. When you analyze a business transaction, it is your prime duty to classify the particular transaction in three different aspects. For that, you have to learn what is a journal, what is journalizing, what is ledger, what is posting, like that. Similar terminologies are there. First, we will analyze a business transaction. Okay. Now you tell me, you have learned this thing, no? Just because this is a revision class, I am not going into deep into that. This is basics. Okay. Now you tell me, how many aspects are there in a business transaction?
2.
How many aspects are there?
2, sir.
Two aspects. First one,
Debit and
Debit and credit.
second one is credit. Okay. For any transaction, there are two aspects. One is debit aspect, another one is credit aspect. What is the concept? What is the name of this concept?
Dual aspect.
Dual aspect concept or double entry dating. Is it not? For every business transaction, there should be a debit aspect and there should be a credit aspect. Sometimes it may be multiple debits and credits. Then what we will call multiple debits and credits in a single transaction.
ECS.
What is the meaning? What is the name of that transaction? Particular entry.
ECS transaction.
More debits and more credits. Okay. Then it is what type of
Match.
transaction? Eh?
Composite
Composite entry. It is a composite entry or compound entry. Compound entry means more than debit, more than one debit and more than one credit or simultaneously, whatever may be. More than one is there, but it should match. The debit should match with the credit. That is known as assets should match with the liabilities. What is the concept? Assets should always match with the liability. What is the concept followed here?
Matching concept.
Not matching concept.
Going concern.
No, dual aspect concept only. It is also a dual aspect concept. Matching is different. I will come to that. Okay.
Accounting period.
What is this debit and what is credit? What is debit and what is credit? Debit is giving aspect and the credit is of course receiving aspect. For simple understanding, it is not exactly like that. For simple understanding in any transaction, giving aspect is debit, receiving aspect is credit. Okay. Now we will move to the next stage. Any transaction, when you record in the books, you have to analyze the type of account. How many types of accounts are there?
3.
Three. First one, personal account. Second one, real account.
Nominal account.
Nominal account. So there are certain rules attached to this. What is the rule for personal account?
Debit the
Debit the receiver, credit the giver.
Credit the giver.
Debit the receiver, Yeah,
Credit
debit
the
the receiver of the benefit and credit the giver of the benefit. Okay, real account, debit what comes in,
Debit what comes in,
Debit
what
what
goes
goes in.
goes out. Nominal account, nominal account,
Debit all expenses, losses,
Debit all income and
credit all incomes and gains.
very good. So I have summarized here like that. So personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. Suppose I am telling you salary paid. Salary paid. Now you tell me what are the two different aspects in this salary paid?
cash
Cash and nominal account.
Yeah,
Cash.
one is cash paid, another one is salary.
Unlimited cash.
One is cash paid, another one is salary. So there are two different aspects. One is cash salary, another one is cash paid. So salary is coming under nominal account and cash is coming under real account. Now we have to apply the rule for journalizing. So if you want to record salary, you have to analyze the rule for nominal account. Nominal account, debit all expenses and losses. Since the salary is an expense, it has to be debited. So debit. And the cash account coming under real aspect. In real account, debit what comes in, credit what goes out. In salary, you are giving cash outside. So cash is going out. So credit aspect for cash. Likewise, we will decide to debit or credit a particular entry. Now, this is known as British approach. That is golden rules for journal and journalizing. So what is the golden rule for journalizing? We have to bifurcate the accounts into three aspects: personal account, real account, and nominal account. Then we have to apply debit credit rules. This is known as British approach or golden rules of accounting. Now, on a later stage, one modern approach, which is known as American approach, have been developed. There, the real account, personal account, nominal account are not being bifurcated like that. Instead, any transaction, 5 aspects will be analyzed. Questions will be asked whether asset is there in one of the aspects, whether a liability is there in one of the aspects, whether one of the aspect is capital, or whether one is revenue or expenses. And if the answer you are getting that it is an asset, then second question you will ask whether because of the transaction asset is increasing or decreasing. If you get the answer the asset is increasing, you have to debit the asset account. Increase means debit the asset account. If the answer you are getting is decreasing, then credit the asset account. For example, first one, purchased furniture for cash. Purchased furniture for cash. Then now you tell me here, what are the two aspects? Number one,
Furniture.
furniture. Number two,
cash.
Cash.
now what you have to do is in the modern approach, you have to analyze the furniture first in the list. Furniture, where it will come, type of account, where it will come?
Asset.
It will come in the asset side, asset item. Asset item. Okay, cash, where it will come?
Asset.
Asset. Both are assets here. Now you ask whether furniture has increased or cash has increased.
Furniture.
Furniture has increased. So debit the whatever item increased. Increase means debit. Here you have to debit which item then? Furniture.
Cash.
Cash decreased, so cash has to be credited. Likewise, in the modern approach, journalizing is happened in 5 different angles. That is, the types of accounts are different, not like three type of accounts in the golden approach. It is 5 different types of accounts. One is asset, another one is liability, third one is capital, fourth one is revenue, and fifth one is expense. Now this is an exercise for you. You have to help me. From the following transaction, state which item has to be debited and which is to be credited. Anil started business with the cash.
Decrease.
Cash account debtor to Anil's capital.
Cash account debtor to Anil's capital. Yes, capital. Now you tell me cash account, what type of account it is, whether it is personal, real or nominal.
Real.
Real
Real,
account.
sir.
Capital.
Real account.
Anil's capital.
Liability.
No. What type of account it is, whether it is a
Nominal,
personal
sir.
account.
Nominal
Real account.
Wrong. Nominal means expense.
Personal account.
Personal
account.
Yeah, nominal. Silent,
Okay,
please.
sir. Personal,
No,
personal.
nominal means it is expense or income. It is not an expense. It is not an income. It is a personal account. Anil's capital account. What is a personal account? Any account in the name of a person or entity is a personal account. Is
Individual
it not?
personal account, sir.
Yeah, it is purely personal account. Purchase furniture for cash.
Furniture and cash.
Furniture account data.
Furniture debit, cash credit.
What is the type of furniture? Whether real account or personal account or nominal account?
Real account. Real account.
Real account.
Cash.
Purchase with the furniture, debit
Real
account.
Cash also real, sir.
goods,
Real. Okay.
debit cash account and credit the goods.
Purchase account debtor. Purchase account debtor to cash.
To cash.
Yeah, why we have debited here the furniture and here the purchase? Why we have debited like that?
So purchase is a long term generating, sir. Purchase is a short term, sir.
Short term, not for that. Not only that, the purchased goods are for the purpose of resale. Is it not? The main activity. Sold goods for cash.
Okay.
Sold goods for cash.
Debit
Cash
cash.
account,
Cash
depreciation.
account with the sales.
Now, I will tell you one clue. Whenever cash is debited in our book, it is a receipt of cash. Whenever cash is credited in our book, it is a payment of cash. Remember it. So, any transaction, first you have to bifurcate into cash or credit, so that one aspect will be easy for you. If it is a cash receipt transaction, cash account should be immediately debited. If it is a cash payment transaction, the cash account should be credited. Now, I will record the entry just to go through it. If at all any doubt is there, you can ask. Paid salary, it is a payment, so the cash should be credited. Salary is a nominal account, so salary nominal is debited and cash is credited. Received commission, because I received cash, cash should be debited. Receipt of cash, because of commission, I received cash, that is commission account is credited. Purchased goods from Raman, purchases account debtor to Raman. Raman, why I have debited Raman means it is not a cash transaction. Raman has supplied the goods on credit. I owed this money to Raman on a later date. Sold goods to Krishnan. Similarly, Krishnan is a debtor because he has received the goods, debit the receiver, and sales account should be credited. So here another clue for you. Just like cash receipt is always debit, cash payment is always credit. Like that, purchases always debit, sales always credit. Purchases always debit and sales always credit. Another clue, third clue. If a person's account in our book shows a debit balance, he is a debtor. If another person's account shows a credit balance in our book, he is the creditor. Now, paid cash to Raman. Paid cash to Raman means it is a payment. Cash payment means immediately I have to credit cash. Whenever cash is receipt is there, I have to debit cash. Whenever cash payment is there, I have to credit cash. So I immediately have filled this column. Then the another thing very easy for me, because who has given this money? Raman has given this money. So Raman account debtor to I have given money to Raman. He has received money. So Raman debtor to cash. Received cash. That means immediately I will debit cash. Received means cash should be debited. From whom I have received? From Krishna. So Krishnan's account will be credited. Received rent. Immediately cash receipt. I have to debit cash. By way of rent, I received this cash. And received commission, received interest. Everything is like that. Cash account debtor to interest account. And similarly, commission. Received commission, cash account because cash receipt. Commission is the item. Because of the commission, I received cash. Received cash on account of Suraj. That is again cash receipt. On account of Suraj means Suraj owed this money to me. He has now paid that money. So Suraj account is credited. Anil started business with the cash. Similarly, we have done it earlier. Purchased furniture, purchased cash, sold goods for cash, paid salary. Those things repeated. Okay. Now you tell me what are the type of accounts involved?
Sir, please tell me first entry, please.
First entry. Anil started business with cash. Cash account debted to Anil's capital account. So here, cash is a real account, Anil's capital account is a personal account. Okay. Now you tell me one or two. After that, I will fill it. Salary is paid. Account involved.
Nominal and cash.
Nominal
And
account.
cash.
First one is salary account. Second one is
Nominal, real.
no. There are two types of accounts involved in the transaction. One is salary and one is cash. Salary nature of account is nominal. Cash is real. So debit what is the debit? What is to be debited and what is to be credited?
Salary account debit.
Nominal.
Salary to
Nominal
be
is
debited and cash to be credited.
Cash
cash
account
is
debit.
credit.
Now you see, I will fill those things. You just examine whether it is correct or not. Now rent paid. Two aspects are, one is rent.
Rent account, cash account.
Rent cash.
Yeah. Rent is nominal.
Nominal, cash is real.
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 Debit.
Nominal account, real.
Nominal account.
Rent and credit
Credit
cash.
cash account.
Okay, commission paid, interest paid are similar to that of interest received.
Similar. Now account received, interest
account,
received, interest account.
Cash.
plus,
Nominal
Cash account debtor.
This is real account. Cash account debit. Cash account debit. Interest account.
Interest account pay.
Paid yours the similar entries. Bought my machinery. Bought machinery. Machinery
Machinery
is one
account,
account.
cash account.
cash account.
Another
Cash account.
What is the type of this thing machinery?
Nominal.
Real account.
Both
Real.
real.
Both real.
Real account. Real account. So
Sir,
here real account told,
what is the difference between furniture
Not
account and machinery account, sir?
machinery account, furniture accounts are fixed assets. Separate accounts will be there maintained in the book. Those are real accounts and they are purchased to run the business. That is why we are not debiting purchase account. Instead, we are debiting concerned for fixed asset account. So here machinery account will be debited because machinery is coming into the business. So machinery is debited, machinery debited.
Cash credited.
And cash is going out of
Credited.
business, cash is
So
credited.
cash credited.
Okay. Raju brought capital. Raju brought capital.
Capital account.
Capital.
Raju capital account is one
Capital
item.
account.
Cash is another item.
Cash is another item.
Now capital is a personal account.
Cash real account.
Cash is a
Real account.
Account.
Yeah. Then where you have to debit? Cash debited.
Yes, cash debited.
Raju
Sir,
capital.
Raju brought capital means the same as annual started business with cash only, no? The same meaning.
Same thing. Raju brought capital means he has bring in capital for conducting the business. Same meaning. Withdrew money for personal use. A new item. Withdrew money for personal use.
Drawings account.
Drawings. Drawings.
Drawings.
and cash.
Yes.
Cash.
So debit. What is drawings? Personal account, real account, or nominal account?
Nominal.
account.
Personal.
Personal account, real account, credit, debit the cash, credit the
Debit.
Drawings debit.
drawings, debit,
Debit. Cash.
credit.
Okay. Now instead I am changing it. Withdrew money. Instead of withdrew money, withdrew goods for personal use. Withdrew goods for personal use. Then one is drawings. Another one is whether cash or something else.
Good, sir.
Goods. Very good.
Yeah.
Yeah.
Goods.
Now this is personal account. This is real account. What is the rule?
Real account.
Drawings
The
debit.
Debit
Which
drawings and
drawings, credit the goods
cash
account.
goods account. Goods account.
Goods
We
account
will.
credit.
You have to either categorize goods as a purchase or purchase return, sales or sales returns. Which item you will categorize here? Because you cannot use the word goods in books. Goods is bifurcated into 4 categories.
Okay, sir.
Incoming goods are purchases, outgoing goods are sales. When incoming goods are returned, it is purchase returns. When outgoing goods are returned, it is sales returns. You have to categorize in any one of this. Which item you will?
sales.
Sales. Suppose I am
Sales.
putting it as sales, whether it is includes profit also. If I am including this as a sale, outgoing goods, whether it includes profit also,
Yes,
whether
sir.
whether any proprietor will give profit for his own goods.
No.
Yes, sir.
No,
Then
no
what is the
profit, sir.
concept?
No profit, sir.
When we
Purchase return, sir.
make the sales, we will get the profit also, sir.
Definitely, he has to withdraw the goods as purchase value. Is it not? I am a owner of the business. Why should I take it in sale value? I have to take it in purchase value. So now I am amending my rule. Earlier I said purchases always debit, sales always credit. I have mentioned this statement. Now slightly one exception I am giving. Whenever goods are withdrawn by the proprietor for his personal use or when the goods are withdrawn by the proprietor for giving it as a sample for his business, then it should be reduced from the purchase in the purchase value. Only in those two scenarios, purchase will have a credit. Otherwise, always purchase will be debit. So now remember two situations. One is the goods are withdrawn for personal use, credit should go to purchase account. If the goods are withdrawn for advertisement purpose, giving us a free samples, then purchase account, then also the advertisement account will be debited and the purchase account should be credited. Clear? Keep your mic mute position, please, madam. Double entry bookkeeping. For every debit, there must be a corresponding credit.
Salary, outstanding salary difference.
I will come to that. That is in a higher stage, no? We have not come across with that so far. Only simple entries we have analyzed. Okay. Now, the first of all, you have to record the transactions in the books of the original entry, which is known as journal. So, journal is the book of original entry. Remember it for examination. Journal is known as the book of original entry. Okay, where you are recording the transaction immediately after the business transaction is taking place. So, this is the format of journal. Date column, particulars column, ledger folio column, debit amount column, credit amount column. Now I will show you how to record a transaction in this journal. You can also assist me. A started business is 50,000. Stock is 1 lakh. Furniture is 1 lakh. Now you tell me how you can assist. You have to assist me. A has started business with the cash rupees 50,000, stock of goods 1 lakh, furniture 1 lakh. How we can record it? How many aspects are there in this transaction? One is cash, another one is stock, another one is furniture. Since A has introduced this, there is a capital. 4 items are there. Now you tell me which are all the items to be debited, which are all the items to be credited.
Capital account should be debited.
Capital account debit.
Cash
Remember one thing, capital will not be credited at any circumstances. Capital will not be credited under any circumstances. Remember, there will not be no debit entry for the capital. Clear? Capital is always shows a credit balance. It is a liability. Remember it. All liabilities are the credit. All assets are debit. Now here, debit what comes in rule you have to apply. Cash is coming into the business. You are sitting in the counter. So he is handing over cash. He is handing over stock worth of 1 lakh. The proprietor is handing over furniture worth of 1 lakh. All are real items coming into the business. So you have to debit each and every item. Cash account 50,000. Stock account 50,000. Sorry, 1 lakh. Debit stock. Debit furniture. Again 1 lakh. Now you have to afford credit to whose capital account? A's capital account. This is known as a compound journal entry. Compound journal entry or opening journal entry. Both way you can call it as. Because multiple debits and credits are there. Multiple debits and single credit is there. That is why it is a compounding journal entry. And since this is the opening entry for the business, opening balances are recorded in the business, it is known as opening journal entry as well. Clear? Whether it is clear? Now we have
Compounding entry.
Compounding journal entry means more debits and single credit is there here. No. Suppose any transaction which involves multiple debits and credits in single transaction. Because this is only one journal entry, but there are 3 debits and 1 credit. Is it not? Multiple entries are there. That is known as compound journal entry. Debit you have to mark it like that, and to credit you have to mark it too. So this is the
compound and composite are same.
Composite are same thing, same meaning. Composite journal entry, compound journal entries are on same meaning. So journal entry, what we record the particulars column about them. But why this ledger folio column is there? This ledger folio. Anybody? Why ledger folio is given in journal entry? Journal, the book journal.
Reference to ledger book, sir.
Yeah, after recording the transaction in the journal, it is your duty to post these entries in the respective ledger account. When you post it in the ledger, cash account may be in page number 1, stock account may be in page number 5, furniture account may be in page number 10, capital may be in page number 20. So what you have to do after recording this cash transaction posting in ledger, you have to put 1. That is, it means that in the ledger, first page cash account it is recorded. And then again stock when you post it, it will be on the 5th page. Suppose furniture, it is on the 10th page, capital on the 15th page, like that. So if you record the transactions in the journal, it is known as journalizing, and if you post it in their respective ledger accounts, it is known as ledger posting. And normally you will give a small description of this particular transaction. Started business with the cash, stock, and furniture. What is the name of this small description of the transaction?
Narration.
It is known as narration. Okay. Now we will analyze the importance of a cash transaction with the bank. There are certain rules for the banking transaction. First one, normally the business will open a bank account with any bank and they will deposit money. So the transaction is cash is deposited into the bank. Now bank account is debtor and the cash account is credited. Why we are debiting bank account and crediting cash account? You apply the modern approach now. In both approaches,
cash is a real account.
Cash is a real account. Bank account?
Personal
account.
Debit the receiver, credit what goes out. So receiver is bank, debit the receiver, bank account is debtor, credit what goes out. Cash is going out of the cash box. So cash account is credited. In modern approach, bank account as well as cash account is asset. When asset increases, you have to debit it. When asset decreases, you have to credit it. Here, which asset is increasing?
Bank account.
The asset bank account is an asset. It is increasing, so we are debiting it. And the cash is also asset, but it is decreasing. That is why we are crediting it. So remember, in the modern approach, when the asset increases, it has to be debited. When the asset is decreases, it has to be credited. For examination, they will ask like that only. They will not ask you to do the journal transaction, journal entry. Why I am explaining this? In order to understand the concept clearly. In the case of liability, any one of you tell me when a liability has to be debited or when a liability has to be credited.
When the liability is decreased, then we have
liability decreases, then it is debited. Liability increases.
When an expense has to be, how an expense has to be recorded? When an expense is to be debited?
Increases when it increases.
When it increases, it has to be debited. When an income is to be debited, credited?
Increases. When income increases.
When income increases, we have to credit it. Is it not? That concept will be, you should be thorough with that concept, because definitely 2 or 3 questions will be there from that particular area. When cash is withdrawn from the bank, similarly cash account is debtor, bank account is credited. Because the receipt of cash, always cash account is debited, is it not? When a check is received from a customer, when a check is received from a customer, initially it will be treated as cash. Thereafter, it will be paid into the bank account, because normally a business firm, they will collect all the checks on a particular day, whatever they are receiving, and they will pay it into the bank, those checks on the next day only, is it not? Because they will not do it each then and there. Nobody will be there in the business organization to go to the bank and immediately it has to be paid into the bank. They will not do it like that. In the evening, they will collect, they will account all those things. So those who have given checks will be accounted properly. Then it has to be paid into the bank on the next day. So whenever a check is received in a business organization, they will immediately treat it as cash, because they are putting it along with the cash in the cash box. So the check is treated similar to that of cash when it is received. And on the very next day, when it is paid into the bank, then the cash will be taken. It is treated as a cash payment from the cash box and credited to the bank account. Now you see their entries will be like that. That is today. What is the date today? 10th, no? 10th of November. Received check from Keshav. Now you tell me the entry as on 10th journal entry. You have to put it immediately. No, what is the entry for this? Received a check from Keshav.
Cash account debit.
Cash account debtor. 1 lakh.
Cash.
Keshav account.
Keshav 1 lakh. Now on the next day, on 11/11/2022, Keshav's check paid into bank. Paid into bank means the paying slip has been prepared and it has been deposited with the bank. What is the entry?
Bank account data.
Cash account.
Bank account debtor 1 lakh to cash. Now you see here in the first entry debit cash and in the second entry credit cash will be nullified on 11th of November. If you nullify the debit cash and credit cash in the first and second entry, the resultant entry will be bank account debtor.
Bank account debtor. Cash account credit.
So only in this circumstance, the customer will treat it as a cash on the first day and it will be paid into the bank immediately on the next day. Suppose I am amending this like this. On 10/11/2022, received a check from Keshav 1 lakh and immediately paid into bank. If I am amending the entry like this, what will happen for our journal entry? Whether 2 entries are required now?
No, sir. Bank account debtor.
Yeah, bank account debtor to Keshav. That is enough. This entry is not required. Bank account debtor to Keshav is enough. Okay, remember this because further if you study, we will study the bank reconciliation statement and other thing. There you have to use this technique. Now, if any payment is happened from the bank, definitely immediately the customer will reduce his bank balance. Suppose the entry is like this. Paid rent to landlord for the month of October 2022, 15,000. Paid rent by check. What is the entry? Paid rent to landlord for the month of October 2022, rupees 15,000 by check.
Rent account debit.
Whether we have to debit rent account or landlord account. Who is receiving this check? Debit the receiver, no? Landlord. Whether we have to debit landlord or renter.
Landlord.
If you debit landlord, he will become a debtor. He will become a debtor.
Rent account, sir.
Landlord debit, sir.
Landlord debit.
Rent account.
Rent account.
Rent credit.
Rent debit.
Rent account.
Rent debit, sir.
Credit to landlord account.
Bank.
To cash or bank?
Bank account.
To bank account.
Because whenever the customer is issuing a check, immediately he will reduce his bank balance. He will not wait for when the other person is going to present in the bank. He will not wait for that. Immediately he will reduce it. Maybe the landlord who is collecting the check may encash it on a later date. That is irrelevant for the customer. So remember, when a check is issued, immediately it will be reduced in the bank balance. Okay. Why we are not debiting here landlord? Because the rent is being paid, it is a cash transaction. Once if it is paid, there is no relevance for a personal account tab. Because already paid, why should we account that personal account into our journal? That will create either debtor or creditor. Here he is not a debtor. Here he is not a creditor. We have already paid the amount. Then there is no question of creditor or debtor. Hence, rent account should be debited. Landlord account should not be debited. Okay. Rectification of errors, you have to learn these type of entries. Definitely by the question paper, they will ask like this. So if there are 3 aspects, here 3 aspects are, one is rent, another one is landlord, the third one is bank. If there are 3 aspects, you have to analyze the transaction in such a way that whether any relevance has to be given to the person. If you give debit or credit, he will either become debtor or creditor. But that is not the sense, is it not? Debtor means he owes money to us. Creditor means we owed money to him. Suppose if you debit landlord in this account, that means the landlord is owing that much money to you. So the entire meaning will go. So if there are three aspects like this, then you have to give importance for the cash aspect only or bank aspect only and not to the person, because there is no relevance for the person. Another example I will tell you. Similarly, very easy for you to understand. Purchased goods from Matthew and Company worth rupees 1 lakh and paid by check. Now you tell me what are the three aspects here? One is purchase.
Bank account.
Second one is Matthew and Sons. Matthew and Company. And third one is bank. Now you tell me only two aspects we have to take. Three aspects will not come, no. Only either debit or credit, is it not? Only one debit and credit. Now, which item you will remove from this?
Purchase bank.
Purchase you have to remove or Matthew you have to remove?
No,
Matthew.
Matthew account.
You have purchased goods. Now there is a question whether you are paid for that or not. Here you have paid by check. That means if you paid, there is no importance for Matthew and Company because you have already paid. Why should you credit him? So purchase account debtor to bank will be the correct entry. Purchase account debtor to Matthew will be a wrong entry. If you put it like that, then the accounting message which it will give is the business is owing that much money to Matthew. Whether it is real, whether it is correct, no. The business is not owing; it has already paid the amount by check. So when there are three aspects, you have to remember that if it is a cash transaction, there is no relevance for the particular personal account. Similarly, check received. Check received from a customer paid into the bank for collection. Bank account to cash, that is a normal entry only. Interest on deposit allowed by the bank. Bank account debtor to interest, because interest here it is an income. So credit all incomes and gains. And the bank account, of course, our asset is going up. Increase in asset, we have to debit bank account. Then charges made by bank for their services. Bank charges account debtor to bank, because our bank account balance will decrease. Bank charges is a nominal account, debit all expenses rule. So we are debiting bank charges. Similarly, when the proprietor is taking money from bank account of the business, the drawings account will be debited and the bank account will be credited. Here asset is decreasing, bank is an asset, asset is decreasing, you have to credit it. Check issued to a supplier. Supplier means goods supplied by somebody. Then supplier, who is receiving that check? Supplier is receiving. So supplier's account debtor to bank. Check received from a customer paid into bank for collection, returned dishonor. This is the most important entry. One check received from a customer, we have already paid into the bank, but it is now returned dishonored. Means that when the person who is a debtor, he has given a check. When he gives the check, in order to wipe off his debit entry, we might have credited him. Is it not? Now that credit is null. We have to nullify that credit. So his account will be debited, customer account will be debited, and the bank account will be credited. I will give you the sequence why it is happening like that. Suppose Mr. A purchased goods. A purchased goods on credit. What is the entry? Say journal entry. A purchased goods on credit.
Purchase account debtor to A.
Purchase account debtor. Debtor to A. So now.
Yeah. To A.
To A. Now tell me. Suppose A. We are giving check to Mr. A. What will be the entry?
Bank account. Bank account.
Bank account debtor or creditor? Who is receiving the check?
A debtor. Bank.
Now, because of no balance in the bank account, the bank returned the check. And A is now approaching us, sir. What you have given a check that is returned and paid? What should be the entry?
Bank account debtor to
Bank debtor, A creditor.
Bank debtor to A. Similarly, which has happened in the supplies account also. Okay, now you have to reverse that entry as it is. This is for purchase. Now for sales, how it will be? A credit sales. Okay. Instead of purchase, sold goods be on credit. What is the entry? Sold goods to be on credit.
B
B
account
account
debit to
debit to
sales
sales.
account credit.
Sales account.
B debtor to
Sales
Sales
account.
credit.
now B received from B. What is the entry?
B is creditor.
Bank account debit
Check
to
is
B.
debtor.
Bank is debtor.
Bank
Because
is
we are
debtor.
getting check
B is
to
creditor.
B.
To B account.
Yeah, that is what I want. Cash account debtor to B. Then paid is check into bank. What is the entry? Bank account debtor
Bank
to
account
cash.
is debtor. B's
To
account
cash.
is creditor.
To cash.
To cash.
Now, B is check returned dishonored. B is check returned dishonored.
Bank debtor to
Yeah,
cash.
bank account credit, B account to debit.
Now you tell me who is B, whether he is a debtor or creditor.
Debtor.
Bank is
Debtor.
B is
Debtor.
debtor.
B is
Okay, he is
creditor.
a debtor. Is it not? B is a debtor. Now, because of the return of check which he has given, his debit status, debtor status should be reinstated. Is it not? That is why you are debiting him. So B is again indebted to us to the extent of this amount. So B debtor, he will again become a debtor, and we have to cancel the bank. B debtor to bank. Okay, that is what is listed in the 9th this particular receipt. Customer account debtor to bank. So customer is a person who is a debtor who purchased goods from us, and supplier is a person is a creditor who supplied goods to us. Opening journal entry, compound entry, composite entry, everything is correct. Then now discount, there is an aspect known as discount. Discount means there are two types of discount. One is trade discount and another one is cash discount. Suppose a discount is being allowed at the time of purchase itself. 10,000 rupees worth of goods has been purchased by a party. We sold goods and we allowed a 10% discount on that in the invoice itself. Then we will put a journal entry only for the net transaction of 9,000. What is the effect if you put it like this? You see, this discount, suppose if you examine it in a separate way, sold goods for cash, or sold goods worth rupees 10,000 at a discount rate, discount of 10%. Suppose you put it like that. Cash account debtor 9,000. Discount account debtor 1,000 to sales. Whether if you write like this, what will happen? If you write like this, what will happen? You are paying GST for 10,000 rupees, is it not? You are paying GST for 10,000. Whether you are supposed to pay 10,000 GST for 10,000, how much you got from the sales?
9,000.
Only 9,000. That is why whenever if there is a reduction in sale invoice value or purchase invoice value, that discount will not be shown in our account. Instead, only for the net amount we will put our entry. Otherwise, unnecessarily we are paying tax. So remember, if a discount is deducted in the invoice itself, whether at the time of sale or at the time of purchase, then it is known as a trade discount. We will not record a trade discount as an expenditure in our book. Once again, I am repeating, we will not. Hey, mic, all persons, please put your mic in mute position, please. We will not record this trade discount as an expenditure in our book. Clear? Only for the net value we will record the transaction. But at the same time, a cash discount is different. Cash discount, it is for a prompt payment or prompt receipt of cash. There is a debtor. Mr. A is a debtor. To the tune of 5 lakhs. he agreed to pay the amount within 60 days. So he borrowed, he has taken goods from us and he is a debtor now and he has agreed that he will pay the amount in 60 days. But upon completion of 30 days, he paid the entire amount. Now you have received, as a business firm, you have received your money 1 month ahead. Because of that, now you are willing to give him some concession. Because he has agreed for the 60 days, that is why you priced your goods accordingly. You remember this, you have priced your goods 5 lakhs accordingly because at the time of sale itself, you very well know that you will get the money back after 60 days. But now you are getting the money 30 days in advance. 30 days in advance means you have to, Banu, please keep your mic in mute position. So upon completion of 30 days, he has prepaid the amount. Now, just imagine a 5% discount or 2.5% cash discount is allowed. (2.5% cash discount is allowed. Then how the entry will appear in the books? What is the quantum of the, now tell me what is 2.5% of
Discount.
5 lakhs? How much?
12,500.
Yeah. Then you will receive cash less 12,500. Is it not? Cash account debtor rupees 4,87,500. Then discount is an expense for you. Discount account debtor rupees 1,500. Then you have to account him, Mr. A, because he has a complete amount he has given. You have to give credit for 5 lakhs. Otherwise, something will be remaining in his book. Is it not? Now he is not indebted to us in any way because he has fully paid. At that time, we have allowed him a discount. So cash discount is an expenditure in our book, whereas trade discount is not an expenditure in our book. Clear? Why? Because unnecessarily, otherwise we have to pay GST and other things. So this is recorded there. Now we will move to the ledger posting. Ledger is a collection of all accounts debited or credited in the general ledger in the general journal or various special journals. We will come to that special journals later. So ledger is the secondary entry or the principal or main book entry. Principal entry or secondary entry, or these are the other names given. For examination, this is important. So posting an entry from journal to ledger is known as posting. And the format of a ledger is like this. It has two different portions. That is, one is on the debit side and one is on the credit side. Both sides of 4 columns will be there. Date column, particulars column, journal folio column, amount column. So when an entry is to be posted in the particular ledger, the ledger should have a heading, that is either cash account, furniture account, machinery account, like that. Each and every particular item is recorded as a separate. This is known as summarizing. Summarizing of the record. We are summarizing, we are segregating the item in such a way that at any point of time we can point out what is the total purchase, what is the total sales, how much is owing from Mr. A, how much we have to give to Mr. B, what is the total salary paid during the year, what is the total rent paid during the year. So for that questions, it is very essential. We have to prepare ledger accounts. So this is ledger account listing. You see one entry has been posted here. X started business with the cash account debtor to capital account. So in the ledger, first we will open a cash account, and in the ledger, same ledger, we will in another page we will open capital account, and this entry will be posted. In the journal entry, cash account is debited. So in the cash account, we have to select the debit side of the cash book, because here it is debited. We have to take the debit side of this cash book, and there we will record with the prefix to capital 10,000. Similarly, in the journal entry, capital is credited. So in the capital account, you have to select the credit side of the capital account, and by cash, you will record by cash 10,000. So in the capital account, the particulars column, you cannot see the word capital. In the cash account, in the particulars column, both the debit or credit, you cannot see the word cash. Why? Because if you write cash inside the debit or credit columns, it will mean that cash account debtor to cash. There will not be such entry, is it not? So the same aspect, we will not debit and we will not give the debit and credit in the same entry. No way you can find a journal entry like this, cash account debtor to cash. Then only it will come like that. So cash account, the opposite aspect has been recorded. Capital account, the opposite aspect has been recorded. Now, if you balance this, suppose if you imagine there are several entries, and if you balance this, if the debit exceeds the credit, we can say that this account shows a debit balance. If the credit exceeds debit, we can say that the account shows a credit balance. And if such accounts are arranged in either debit or credit, it will be known as trial balance. So after preparing the ledger accounts, the accounts will be balanced and that will be arranged in a systematic manner, debits and credits, so that all the debits, if you add it, that will tally with all the credit balances. That checking is known as trial balance. So we will come to that later, to the trial balance. Now we will see certain subdivision of journals which are being given for easiness of the accounting. Because most of the journal transaction, you might have witnessed that most of the transactions are having cash aspects. Cash is the main aspect in most of the transactions. So why can't we segregate this cash into different aspects? Cash into one particular journal. So in that way, subdivision of journal has been originated. So most of the 60-70% of the transactions are of course of cash in nature. Instead of keeping a cash account separately in the ledger, a cash book can be maintained. So cash book is a subdivision of journal, and maintenance of cash book will serve the purpose of maintaining a cash account in the ledger as well. And we can reduce the journal entries in respect of that cash. That is a peculiarity. Just we will go through it. Subdivisions. These are all some ledger postings. We will scroll it down. See, these are all the subdivisions of journal. This is to reduce the workload of the accountant. Otherwise, he has to record each and every journal transactions, each and every business transactions in the journal, is it not? That will increase the workload. In order to reduce it, certain transactions are segregated and recorded in a particular daybook so that journal entries can be avoided. So you need not write journal for that. Such segregation are cash transactions, purchase transactions, sales transactions, purchase returns transactions, sales returns transactions, bills receivable transactions, bills payable transactions. Because in any business organization, purchase and sale is the most important item. Together with that, cash is also most important. So purchase, sales and cash, these three aspects are segregated from the journal. And whatever journal entry is required for cash, purchase or sales, you need not write it in the journal. You straight away write that entries in the daybook so that you can avoid journal entries. Simultaneously, in the ledger posting also, you can reduce your workload. We will see one by one. Cash book, first we will say take cash book. What is cash book? Cash book is just like your cash account to record the business cash transactions. So it is a day book in the sense that instead of writing the journal, you will write it directly to the cash book. So here it is very easy to write because you need not go for applying the rules and other things. If there is a cash receipt, you have to put it in debit column of the cash book. If there is a cash payment, immediately you can put it in the credit column of the cash book. Okay, now 1 or 2 entries you have to give me that solution. The first one is started business with the cash. The thing is, you have to say whether it is appearing on the debit side of the cash book or credit side.
Debit side.
Debit side. What is the narration? To capital. Okay.
Cash account debits, capital account credit.
No, I don't want journal entry. Now you are removing journal entry from your mind. Okay. Because you are reducing that workload. Now you have to tell each and every item, you have to tell, sir, it is to capital or it is by purchase like that. Only that I want. Purchase furniture.
Cash account credit.
No, I don't
Payment.
want. I don't want. In the cash book, how
payment.
you will buy purchase.
Furniture account.
Buy furniture. Buy furniture.
Buy furniture.
Next one, purchase goods for cash.
Buy purchase.
Buy goods, buy purchase.
Buy purchase. Sold goods for cash.
By sale.
Two sales.
To sale.
Sales accounts, sir. Two sales accounts, sir.
Two sales. Okay. Open the bank account. Open the
Buy
bank
bank.
account.
Buy bank.
Cash sales. Cash sales.
To sales.
Two sales.
Paid stationery. Paid stationery.
Stationery.
Buy stationery. Okay. Now I will tell you. You listen. Paid rent. Buy rent. Received commission. To commission. Paid Prakash. Buy Prakash. Received from Sugu. To Sugu. Paid salary. Buy salary. Received check for goods sold. Received check for goods sold. Received check for goods sold.
Two banks.
Two banks.
Two sales written.
Two banks.
By bank.
No. Whether any entry will come in the cash book.
It will not come in the cash.
It will come now. First day you have to record it as a cash transaction. Second day it has to be reduced from the bank. So two sales will come. On the next day, buy cash will come. Buy bank will come. Buy bank. Okay. So two sales 500. Buy bank 500. See here. Two sales 500. Buy bank 500. Now another clue for you. Cash book always shows a debit balance. Cash book always shows a debit balance because if there is a cash in your cash box, definitely it should show a debit balance. If it is the nil, there is no cash, then it is a nil balance. It will not go to a credit balance. So cash balance, cash account or cash book, cash balance will not go into credit at any point of time. Remember it. Okay. Now, in the journal itself, another peculiarity has been added to reduce your further work. So now you have removed all your cash work. Is it not? All cash transactions are removed because you need not prepare journal entries. You need not prepare a ledger. So cash book is journal as well as ledger. Now, definitely there may be discount transaction along with the cash. We have learned, even though trade discount is not accounted in the books, cash discounts are to be accounted. So when cash is received, you have to allow discount. When you are paying cash, you can receive discount. When cash is paid, you are receiving discount. You are paying cash now, then you will receive discount. When you are receiving cash from your customer, you are allowing him discount. Remember these things. Okay. Once again, I will repeat it for your better understanding and taking down also. When cash is paid, when we pay cash, we will receive discount. When we receive cash, we will allow discount. Remember it. Take it down in your book. When cash is paid, we will receive discount. When we receive cash from our customer, we will allow him discount. Take it down. Now you tell me, in the cash book, debit side, whether receipts are recorded or payments are recorded.
Receipts.
Receipts. Suppose I am, along with the receipt, I am recording discount also. Whether it is a discount allowed or discount received.
Discount allowed, sir.
Discount allowed.
So in the receipt side of the cash book, I will record all discount allowed. Why? Because whenever I am receiving cash, I am allowing discount. On the payment side, if I am making payment, I will get the incentive in the form of discount. So all discount received will be on the payment side. All discount allowed will be on the debit side, that is receipt side. Clear? So now you see how this is recorded. Here, Mr. Amar. Amar is a party who is a debtor. He has given money. He is a debtor to the tune of 600 rupees. Now, when he paid money 600 to us, we have allowed him a discount of 30 rupees. That means in exactly cash, how much our cash box has been increased by 570 only. Only 570 has been put in your cash box. The 30 rupees is representing the discount, whether this discount is allowed or received. 30 rupees discount
Allowed.
So whatever discount listed on the receipt side of the cash is the discount allowed by us. Whatever is the discount on the credit side of the cash is discount received by us. Clear? That is here. Here we are making payment to Rahim because this is payment side of cash book. We are making payment. That is we have to make payment to the extent of 750. When we pay this amount to him, he allowed him 30 rupees discount. He has given back 30 rupees. Sir, you give only 720 because you have prepaid it. Now, if from the cash box, how much it is going out? Exactly 720 is going out. But in the same sense, how much we have settled with Rahim together with the 30 rupees. So this 30 rupees is an income. So this 30 rupees is an expense. So this is an expense discount allowed, and this is an income discount received in profit and loss account. So this total will be taken as an expenditure. This total will be taken as an income in the profit and loss account. So in examination, sometimes they will ask on the receipt side of the cash book, along with the receipts, whatever discount we are recording is dash. Option A, expenses. Option B, income. Option C, income or expense, like that. Then you have to remember, whenever it is there is a receipt, it is an expense. Okay. When you get money, you have to allow discount. When you pay money, they will give you discount. This is the rationale. And similarly, 3 columns are recorded in order to reduce your cash transactions, discount transactions, as well as bank transactions. So 3-column cash book is the most important one from your examination point of view. Okay. 3-column cash book. Here you have to remember the sequence like this: discount, cash, and bank. So this is discount column, DCB on the reverse order. D stands for discount, C stands for cash, B stands for bank. Here, same way, this is the receipt side, this is the payment side. That means receipt side cash column represents cash receipts. Receipt side bank column represents bank receipts. Whenever amount is increasing in bank account, you have to immediately debit it. On the receipt side, you have to record. Similarly, when the cash is taken out of cash box, it has to be credited. It has to be recorded on the payment side of the cash book. When in the bank account, the balance is getting reduced, it is recorded in the bank column of the cash book. So now you have reduced your work to a greater extent. Discount entries you have reduced, cash entry you have reduced, bank entries also you have reduced. So with the cash book, 3-column cash book, you can reduce discount, cash, and bank column. And since the cash and bank is recorded in the same book, there may be some scenario where you have to record transactions in between these two. Suppose you paid into cash into bank. Cash paid into bank. What is the entry? Cash paid into bank. What is the entry? Tell me.
Bank account data.
Cash.
So here in the same book, the 2 aspects will appear. One on the debit side, another on the credit side. So cash paid into bank means the cash balance as per the bank, that is bank balance. Bank balance is increasing. That means you have to debit or incorporate that amount in the debit side of the cash book. Here cash is a payment. Cash you have to record on the payment side. So one is appearing on the payment side, another one is appearing on the receipt side. That means both the sides, same amount has been either debited or credited. This is known as contra entry, because in the same book, the both aspects are recorded. Very rarely it will happen. That too in the form of cash and bank transactions only. So those transactions, in order to differentiate, there is no further posting is involved. No further ledger posting is involved. In order to denote that, we will mark it as a C in the ledger folio column. It is a contra entry. The posting is also taken care of because both the accounts are in the same book. Cash account as well as bank account is in the same book, 3-column cash book. So no further posting is required. Hence, in order to reduce that, in order to indicate that, contra entries will be marked. So contra entry means if both the leg, debit and credit, is affecting the same book. That is mostly in the cash book. Cash and bank transactions are like that. So sometimes they will ask what is a contra entry. Then there is a petty cash book is also there, a small portion, just to go through because it is an analytical cash book. That is, the cash book is prepared in such a way that the main expenditure are recorded on the first column, and it will be bifurcated into different columns for analysis purpose. How much we have paid under post and telegram, how much we have paid under printing and stationery, like that. In order to know that, analytical cash book is also prepared. Here there is only one question normally they will ask, what is the impressive system of keeping petty cash? Impressive system is nothing but the amount given to the petty cashier. The amount usually usually maintained under the impress system. A fixed amount called impressed amount is advanced to the petty cashier at the beginning. Suppose in the beginning we are giving 100 rupees to the petty cashier. So he has to expend rupees 2 on the first day, 5 rupees, 4 rupees, 6 rupees, like that. At the end of the week, he has expended 96 rupees. Then what we will do? We will again give this 96 rupees to him and make his balance into 100. At no point of time, the balance available, cash available with the petty cashier should not exceed this impressed value. So this is the fixed amount which is to be, the petty cashier can keep with him. Fixed amount it is. Whenever it is reduced, suppose he has spent 96 rupees out of this, immediately this amount will be pumped into his cash book, his cash box, and it will be again reinstated to 100 rupees. This is known as the impress system of petty cash book. As only one question, that is the only possibility of a question from this particular portion. And similarly, we can reduce our work in the purchase transactions, sales transactions, etc. So here purchase daybooks and sales daybooks are recorded. Remember one thing, purchase daybook records only credit purchases. Only credit purchases. Why? Because all cash purchases we have already recorded in cash book. So only credit purchases will be recorded in purchase daybook. Only credit sales will be recorded in the sales daybook. And wherever credit purchase happened, if it is returned subsequently, then we will record it in the purchase returns book. And wherever credit sales happened, if those goods are returned by the customers, then sales returns book will be recorded. So this way we can reduce the work of purchases, sales returns, and purchase returns. Yes.
Credit sales, credit return sales, sales return വരുമ്പോൾ cash ആയിട്ട് കൊടുക്കുകയാണെങ്കിൽ cash book വരത്തില്ലേ?
No, cash actually, whenever we are returning goods, we will record it as a sales returns or purchase returns only for credit transactions. If suppose he sold goods for cash and he is returning that goods, it will not appear in the sales returns book. Instead, it will appear in the cash book itself. Because when he is returning it, when the sales is made, you have recorded it as a receipt. When the customer is returning it, you have to give that money back. Is it not? In that way, it will appear on the payment side of the cash book itself. No, normally the cash transactions will not be returned, is it not? There will be a saying in the invoice, once sold will not be taken back. So normally it will not happen. So wherever I am mentioning sales and sales returns, purchase returns, everything denotes credit angle only, credit transactions only. Like that, bills receivable and bills payable books are also there. So that will be for recording the bills receivable aspects and bills payable aspects. So this is regarding subdivision of journal. So now we will examine one or two questions from here.
Sir, inward return, outward കൂടി ഒന്ന് പറയണം സാറേ.
Yes. Some questions we will go through it. Return outwards, return inwards. I will note it. I will give you that in the end of the class. Okay. Now,
Sir, this PPT will we be receiving, sir?
This is not PPT, man, sir. This is actually exactly the book which you have supplied by the IBS. Okay, that's only I have used. Okay, now you try to solve this under golden rules for recording journal.
3.
Accounts are classified into
3.
3, sir.
golden rule for journalizing is also known as
British
British
approach.
approach.
British approach. The basic rule, debit what comes in and credit what goes out, is applied to
Real account.
Real account.
Real account.
very good, very good. There are minimum dash aspects for every business transactions.
2.
Minimum 2. When an asset is increasing, the asset account should be
Debited.
asset minus liability to outsider is represented by
Net worth.
net worth is the correct answer. Assets are considered as
Source of funds.
Sources of funds.
Use of funds.
assets are considered as use of funds. Assets are uses of funds and liabilities are sources of funds.
Sources of funds.
So all liabilities are sources of fund, all assets are use of funds. Okay. So whenever I am explaining something, all of you keep silent so that everybody can hear what I am saying. Okay. When I am saying something, just keep silence. The claim of the honor against assets. Yeah. Assets are, that is when you visualize the balance sheet like this. Balance sheet, this side is asset side. This is liability side. How you procure? Suppose here furniture is there. How you procure this furniture? You should have some amount, no? So there is a capital here. You have the person has introduced some capital. With that money, he has purchased this furniture. So all liabilities are always the sources of fund. All assets are always uses of fund. Okay.
Okay, thank you, sir.
The claim of the honor against the assets of the business is called
Net worth ante
net worth. The claim of the honor against the assets of the business has first preference, second preference, last preference, depends upon whether profit or loss.
Last preference.
Loss reported by a business unit is whether it is asset, liability, net worth, net working capital.
Last is assets.
Loss reported by business.
Profit is a liability.
Liabilities.
Loss is an asset. How loss become an asset and profit become liability? If the business makes profit, the business is liable to hand over this amount to the owner. Is it not? When it makes profit, the business is liable to hand over this amount to the owner. In that way, it is a liability. And loss means the business has ended up with loss. This loss has to be made good by the owner. The owner has to give this money back to the business in order to run the business further. So in that sense, the money receivable from the owner is known as asset. So loss is an asset and profit is a liability. The expenses and income are classified under
Personal accounts.
Nominal
Nominal
okay. Nominal accounts are related to
income
all is the right answer. State Bank of India account in the books of economy say
Please, you only answered all the
one or two.
It is very confusing, sir.
Yeah, one or two, please respond. Otherwise, you keep mum. Any one or two. Okay. When a debtor.
Page number.
Okay, all of them you keep silence. I will give the answer. Okay, I will give the answer.
Page number, please. Sir, page number, please.
No, this is a question framed by me for this particular lesson.
Previous question also.
Previous question. Okay. Previous question. State Bank of India account in the books of the firm. The firm is having an account with SBI. The firm is called that account as a personal account. When debtor
has a representative account is there, sir?
Representative personal account. A representative personal account is different. I will come to that. When a debtor remits money to settle his dues, his account to be
Credited.
Very good. Salary outstanding as on 31st March of a particular year is
Representative.
This is known as representative personal account. Salary outstanding.
representative means
Yeah, I will tell that. Suppose salary paid. Here, salary is a nominal account. Salary payable. Salary payable means what? Salary payable means somebody yet to receive the salary. That means the salary is applicable to somebody which is not paid. So here salary is a first case, salary is a nominal account and cash is paid. Cash is the second aspect. In the second case, salary to be paid, that is, there is no question of non-paying of salary. So salary is a nominal account, whereas salary payable is, salary payable to somebody, salary is payable to somebody. I don't know, maybe one person or one or two persons or three persons. So somebody means that is a personal nature. So we cannot point out Mr. A or B as the person. It includes two or three persons. So it is a representative personal account. So when expenditure outstanding, income receivable, prepaid expenses, those items are representative personal account. It represents somebody. The benefit will go to or benefit will come from somebody. That is the meaning. Clear?
Please repeat once at that point. Representative personal accounts.
Yeah, wherever is sometimes salary outstanding means that much salary is owing to somebody, is it not? Salary outstanding means salary itself is a nominal account. This, if you bifurcate this is a nominal account. But instead, if you take this in full, salary outstanding means the firm is owing some amount towards salary to somebody. So somebody is there who has to get the salary. So that somebody in that particular angle, it is known as representative personal account. So there are four instances of representative personal account. One is prepaid expenses, income received in advance, expenditure outstanding, expenditure income receivable. So these are the four different circumstances when representative personal account will come. Other than that, there will not be any representative personal account. Clear? Take it down.
Arrears.
Prepaid expenses. Arrears.
Arrears.
What arrears? Tell me what arrears. Expense arrears or income arrears?
Income arrears.
Income arrear means income receivable. Income receivable is nothing but income arrear. Is it not?
Okay.
Income arrear means it is income receivable. Expenditure arrear means it is expenditure outstanding. Arrear means something outstanding. Okay.
Yeah.
Clear. Now, rent paid will be credited to rent account, salary account, wages account, cash account.
Cash account.
Cash account.
Cash account. All assets account always shows a
Debit balance.
Debit side.
Debit balance. All assets always shows a debit balance. All
Debit
assets
balance.
always shows a debit balance. All liabilities always shows a credit balance.
Credit balance.
Now, total assets 1,50,000. Outside liabilities 50,000. Reserves and surplus 20,000. Find out capital.
Sir, assets shows in
80,000. 80,000.
Sir, assets are shown in
30,000.
Only one person. You ask only one person. I have to ask. If everybody is talking, I cannot hear. No, only one person. What is the doubt? Otherwise, you put it in the chat box.
1 lakh, sir. 1 lakh.
1 lakh is the answer.
Answer.
No, sir.
1,20,000.
80,000, sir.
80,000.
This is the balance sheet. This is the balance sheet.
1,20,000.
No, just total assets 1,50,000. 1,50,000 assets on the right side. Outside liability 50,000. Reserves and surplus, that is also liability 20,000. Now you tell me capital how much?
80,000. 80,000.
Because
80,000.
as per dual aspect concept, all debits should be equal to all credits. Is it not?
All credits.
Now it is 5 plus 2, 7 plus 80. Is it not? Then the answer is 80,000.
80,000.
Now, certain questions are there in the chat box. We'll come to that.
Sir, one doubt, sir. Here, all assets are showing the credit balance is there, sir.
All assets are debit side, debit balance. Assets are debit balance.
Sir, actually, we write in left side is the liabilities and right side is assets, sir. That time is the debit or credit is there, sir. So assets comes
No, because when you talk about balance sheet, there is no debit side and credit side. It is only a statement. When you talk about balance sheet, it is a statement. There is no debit and credit side. Okay, first question is bills payable. What are bills payable? Bills payable means it is an acceptance given by the customer. When goods are purchased by us, you are sitting as an accountant. and you are purchasing goods from a particular supplier on credit, then the creditor will insist you to accept a bill. So what you will do, he will draw a bill of exchange and you will accept it. In the acceptance, you are saying that after 60 days, I will pay this amount. So the amount is payable from my side to the supplier. So that is why it is known as bills payable. That much amount is payable to the supplier by you. So in your book, it is a liability. In Keshav's case, whether Keshav is issuing check to company or the check issued by company to Keshav. That at that time when I explained it, no, Keshav's checks means already the Keshav has given a check to us. That check is with us. So here the second statement is whatever check given by Keshav is now paid into the bank. So whatever he has given a check, no, that check is now paid into the bank. That is, we are depositing Keshav's checks into the bank. Difference between fixed asset and tangible assets. Difference between fixed assets and tangible assets means fixed assets always tangible, because there are three types of accounts. One is personal account, real account, and nominal account. Real account, there are two types. One is tangible, another one is intangible. So real account, if it is tangible, it is known as fixed asset. If it is intangible, it is known as fictitious or intangible assets, like that. Fixed asset you can touch and feel. That is a fixed asset. When a customer returns goods purchased by him, it is recorded as what type of
Debit to purchase returns.
Purchase return.
Purchase returns. Okay. Difference between expenses and the outstanding expense. Expenses means it is a nominal account. Outstanding expense means a representative personal account. Why? Because suppose salary outstanding. Salary, if you paid, the entry will be salary account added to cash. If it is outstanding, then the entry will be salary account added to salary outstanding account. There the salary outstanding represents the amount due to somebody by way of salary. In that sense, it is a representative personal account. And another thing, if you
please
say
tell me once reserve surplus sum capital assets.
Reserves and surplus is actually along with the capital part of net worth. Net worth is exactly capital plus reserves and surplus. So the outstanding expense and expenses is having some relevance in your bookkeeping. That is, there is a concept that which is known as accrual concept. In accrual concept, for the financial year, particular financial year, whether you have paid salary or not, the entire salary paid and payable should be accounted. So the salary paid as per cash book will be taken first, and salary payable should be taken along with that, so that the total salary for the entire period will be accounted in the particular year, so that you will get the correct picture of the profit. So outstanding salary, it is a liability. So it will come under the liability side of the balance sheet. Outstanding expense comes under which rule? Outstanding expense comes under personal account rule. Personal account rule, debit the receiver, credit the giver. So here the credit has to be given to somebody. So we are crediting outstanding salary account. What comes under personal, real, and nominal accounts? Personal, real, and nominal account. If the account is in the name of a person, company, firm, or like that, it is a personal account. If it is in the name of a asset that is or real or intangible, then it is a real account. Fixed assets or something. Then all expenses and incomes will be nominal account. Fictitious asset means it is somewhat relevant to an intangible asset, but it is fictitious in nature. That means you cannot identify it separately. With a book entry, you can identify. Suppose the firm has made a huge loss. Then that loss, you cannot identify it as a item. No, you can recognize it from the books that this much loss has happened. So that loss is a fictitious asset. We studied that loss is an asset because that much amount is owing from the owner. In that sense, even though it is not an asset because it is fictitious, no, you cannot say that it is a solid asset. Okay. Question number 19, repeat. When a customer returns goods purchased by him, it is recorded as. So when a customer returns goods purchased means it has to be recorded as debit, customer's account, and credit, purchase returns account. Purchase always debit, so purchase returns always credit.
Once explain this 19 again, sir. Return goods by customer
Sir,
means
answers here,
by our customer, right?
Sir, not sales return, sir.
Yeah, sales returns, correct. Very good. It is a sales returns because customer means we sold goods to him, is it not? So when we sell goods to him, customer account debtor to debtor sales. When he returns goods, sales returns account debtor.
Okay, sir.
Customer, sorry. We also took it on the other way. Customer account. Okay, this is correct. Sales returns account debit. Okay, friends, we shall break now. We will reassemble and next time.
19th question answer is credit to sales return, sir.
Sales
Representative real accounts.
Representative.
debit to sales returns.
Debit.
Debit to sales returns.
Again at what time, sir?
Again, 2:30.
Sir, not 2:30, sir. 9:30 is another session is there, sir.
And another session, my session is 2:30. Next session, my session is 2:30. You have another session, mathematics, that is 9:30, no? Okay, we shall meet by 2:30. Okay, that's what I.
Sir.
This
Hello.
question is
Tell me.
Net worth, sir. Please tell me, sir. Net worth, sir. Net worth.
Net worth. Net worth means it is capital plus
It is
premium.
nothing but capital. There is owner own funds, sir.
Net worth means the capital, reserves and surplus, and loss account. Yes. Profit and loss account. So this is known as net worth. Accumulated profit is actually reserve. So accumulated profit is actually the owner is the person who is eligible to get that. In that sense, whatever amount contributed by him is a capital, and whatever is the accumulated profit and other thing that will be added to him. So the net worth means capital plus free reserves. Thank you very much, friends. So we will break now. We assemble by 9:30 for the next session.
Sir, please share these notes, sir.
Yeah.
Please share this note, sir.
Definitely. These questions,
Thank
no?
you.
MCQ. Okay.
Thank you very much.
Thank you, sir.
Answer for 18th, sir.
Hello, sir.
Yeah.
Sir, share with you, sir. Sir, please share this notes. I can circulate, sir.
MCQ. Okay, Sharath. Okay, Sharath. I will give you. Okay.
Sir, what is the answer for 18th, sir?
18th. Total assets 1,50,000. This 80,000 is the answer. 80,000. Because 1,50,000 total asset. This is liability. This is liability. So 70. 1,50,000 minus 70, you will get 80,000.
Sir, 19th question, please explain once, sir.
Yeah, tell me, madam.
19th question, please explain once, sir. 19th question, sir.
19th question. 19th question, when a customer returned goods purchased by somebody, one customer has purchased goods from us. So when he purchased goods from us, it is a sale. When he returned it, then we have to debit sales returns. Okay. When he purchased, he purchased goods from us. So it is a sale for us.
Yes,
when he returned the goods, it is a sales return.
Okay.
Sir, please share entire notes also.
Entire notes, the other thing is only IVS books, sir. That will be that you might have received it. No, otherwise you can pay amount. If you are a new entrant, you can pay that amount to Mr. Sharath so that he will send it to you.
I already paid, but he said after the classes he will share it.
Okay, that's why if you have already remitted after the cash, he will after this class, no, he will send it that particular notes. IBS notes only I have taken as a.
Okay.
This is helpful, sir. You can share the PPT, this notes.
Actually, notes, it is not notes, sir. It is IBS notes. The book supplied to you, no, that only I have shown to you. I have not taken any extra. Only these MCQs are extra things that I will share to Sharath so that he will send it to you. Okay.
Thank you, sir.
Thank you, sir. Yeah, thank you very much. Okay, Sharath.
Okay, sir. Okay.
Up time holo.